All right, so if you're a business owner here in Canada, you know the deal. Getting the right equipment is absolutely essential for growth. But how do you actually do that without completely draining your cash? Well, that's exactly what we're going to break down in this explainer. We're going to give you a clear, simple roadmap. Let's get right into it.
The million-dollar question, right? You know you need that new piece of gear to expand, to take on bigger jobs, to be more efficient. But tying up all your precious cash in one big purchase, that can be a seriously risky move. So stick with me, and we'll show you a much smarter way to handle it.
Okay, here's our game plan. First, we'll tackle what I call the growth dilemma. Then, we'll get into the whole lease versus buy debate. After that, we'll decode the real costs, what you're actually going to pay. We'll also uncover a powerful tax advantage of ownership, and finally, we'll lay out a plan for winning your approval in 2026.
All right, let's dive right into our first big topic, a problem I'm sure every single business owner has run into. You need to invest in new equipment to grow, but paying for it all at once with cash can put a massive strain on your finances.
Man, this quote from Conchetta Farina at BDC just nails it. Think about it, right? Cash is literally the lifeblood of your company. It's what you use to make payroll, to buy inventory, and maybe most importantly, to jump on those unexpected opportunities that pop up. When you lock it all away in one big purchase, you're taking a huge gamble.
Okay, so if we agree that paying cash up front is a no-go, what are your options? It really boils down to two main tools, leasing or buying with a loan. And honestly, the best way to think about it is like renting a house versus buying one. Each has its own set of pros and cons, and the right choice really depends on your situation.
So let's tackle leasing first. With a lease, you get to use the equipment you need right away, but you don't have that huge, scary upfront cost. Instead, you get these nice, predictable monthly payments, which makes managing your cash flow a total breeze. And hey, if you're in an industry where tech changes in the blink of an eye, leasing is fantastic because you can easily upgrade to the latest and greatest stuff.
This chart does a great job of laying it all out, side by side. You see, with leasing, your upfront costs are way lower and you have a ton more flexibility. But you don't own the thing. On the flip side, when you buy, yeah, the down payment's higher and you're kind of locked in, but you're building equity in an asset that belongs to you. And that tax benefit, it's a whole different ballgame. With leasing, you often deduct the payments, but with buying, you get something called depreciation. And trust me, we're definitely going to get into that in just a bit.
All right, let's get to the question that's probably on everyone's mind. What's this actually going to cost? Because whether you lease or you get a loan, there's going to be an interest rate. So what do those rates typically look like here in Canada?
So generally speaking, you're looking at a range of about 6% to 16% for equipment financing. Yeah, I know, that's a pretty big spread, but where you land in that range really depends on a few key things about your business and the equipment itself.
This table breaks it down pretty clearly. If your business has excellent credit, you could be looking at a great rate, somewhere in that 6 to 9% range. If your credit is good, maybe more like 9 to 12. And if you've had some challenges, you're likely going to be in that 12 to 16% range, maybe even a bit higher. It all just comes down to the lender's perception of risk.
So what are lenders actually looking at when they come up with that number? Well, it's way more than just your credit score. They're looking at the whole picture. The type and age of the equipment itself matters. A shiny new machine is a lot less risky for them than something that's 10 years old, you know? The length of the term, how long your business has been around, the health of your financials, it all goes into the mix. Okay, now if you do decide to go the buying route, there is this, I guess you could call it a secret weapon, that you absolutely need to know about. It's a huge tax advantage, and it can save you a serious amount of money.
Is called the Capital Cost Allowance, or CCA for short. I know, it sounds super technical, but the idea is actually pretty simple. Basically, it's the government's way of letting you deduct the wear and tear on your assets over time. So each year you get to write off a piece of the equipment's value, which lowers your taxable income. But here's the kicker. You can only claim CCA on stuff you actually own.
And just to show you how powerful this little tax rule can be, check out this wild story from the 1970s. The government offered a 100% CCA for film production to try and boost the Canadian film industry. And what happened? An absolute explosion of low-budget Canadian horror movies, all financed as tax shelters. It's kind of hilarious, but it really proves how much of a financial impact the CCA can have.
Okay, so you've weighed the pros and cons, you've figured out your path. Now what? How do you actually get the yes from a lender, especially in today's really competitive market? Let's build your action plan. First things first, you got to get inside the lender's head. And right now, in 2026, things are getting tighter. Your passionate story about your business, it's great, but it's not going to be enough. Lenders want to see the numbers, cold, hard facts. Cash flow is king, period.
So here are the 3 absolute must-dos to build a bulletproof application. Step 1, get your financials organized. Seriously, this is not optional. It means having your profit and loss statements, balance sheets, tax filings, all of it ready to go. A professional bookkeeper isn't a cost, it's an investment that will pay for itself 100 times over. Second, you have to show them the ROI, the return on investment. Don't be vague. Boost efficiency means nothing. Do the math for them. Show them, this new truck will let me do 3 more jobs a week, which means an extra $8,000 a month. Be specific. And finally, number 3, clean bank statements. I mean spotless. No bounce payments, steady deposits, and a healthy balance. This is the ultimate proof you can handle the payments.
So I want to leave you with this one thought. The next time you're looking at a big equipment purchase, ask yourself this question. Is this just another expense on your list, or is it an investment in your future? Because when you approach it with the right financing strategy, it's always an investment. You can get the tools you need to crush your goals without putting your business at risk. Thanks so much for watching.